Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me remotely is Phil Mackintosh, Chief Economist at Nasdaq, to review how policymakers and investors are starting to model out the global economic impacts of the coronavirus. And Phil, it's been quite the morning with jobless data and the unprecedented moves the Fed is taking in an effort to keep the U.S. economy afloat. I guess the biggest outlier is the effectiveness of government support will crucially depend on how quickly the aid is dispersed and whether it's sufficient to prevent a major hit to vulnerable households and businesses. What are your thoughts around the jobs number and details of this $2.3 trillion program?
Yeah, so I guess if we look at the jobs number first, we had a consensus of 5 million and we came in at 6.6 million. So actually the consensus was pretty close to what we got, but the scale is just off the charts. And normally this is 200 to 300,000. Having said that, there's a lot of data out there that shows how many businesses have shut down. There's charts that show around 50% of wage workers or more are not earning wages anymore, of hourly paid workers. So this is pretty much expected, although I guess the fact that it's a little bit higher than the consensus has got some economists that I'm looking at revising their total unemployment rate that they might get to. So it looks like with the 15 million claims we've had in the last 3 weeks, we could get up to somewhere between a 13 to 20% unemployment rate at the peak of this. But I think one positive to come out of it is if you look at the rate of business closures, it really accelerated in that week between the 12th of March and the 19th of March. And since then it's stabilized. So there will probably be a similar stabilization of people that are claiming new unemployment benefits at some point relatively soon. In terms of the Treasury action, 2.3 trillion is another phenomenal number, but it's mostly credit and loans, and a lot of it's designed to make sure that the banking system itself doesn't freeze up trying to work out what credit exposures and the balance sheet bloat on a bank will be as it tries to lend these funds out to companies that might not be able to pay them back. So the Fed is doing, and they've said that they will do everything that's necessary to make sure, to your point, that the system doesn't seize up. A lot of people have been saying that a couple of weeks ago, the bond markets really were pretty close to fully closed, and a lot of the high yield bonds are still very difficult to trade. So the Fed is supporting munis, they're supporting corporates and junk bonds, and they're obviously supporting the banks as they lend funds to the companies that are struggling to pay rent while their employees aren't able to earn any income either.
I just want to follow up to that because I would think the average American might have this kind of question. Why buy those kinds of assets, prop up the market, if you will, when that massive amount of money could go towards physical and technology infrastructure jobs? Isn't that what creates a sustainable, healthier economy in the long term versus supporting these assets?
Yeah, I think to put it in a more human scale, you think about when you've got a job and everything's normal, do you go out and buy a super expensive house with leverage, or do you go and buy a sports car that you really can't afford? And the answer is no. But when you get sick, you go to hospital and you pay those bills. And what we're doing right now is going to hospital and paying those bills. The economic consequence of not supporting the people that are unemployed, kind of by design, because the government has said, please stay home and don't go to work and don't go to those shops. We need to support those people and help them help themselves to get food and to stay healthy themselves and safe for the month or 2 or 3, hopefully only, that this is going to go on for it. And that way, when we do go back to work, they will all hopefully have jobs to go back to, have houses that they haven't been kicked out of. They'll be able to catch up on their mortgage payments and catch up on all the things that they want to buy, and also go back and do holidays and the things that we normally do when everyone's healthy.
All right, let's take a look at some of the data here with our next slide. Is COVID-19 under control? It looks as if we had somewhat of a dip, but it has been up over the past couple of days.
Yeah, and I think early this morning, the market was negative before the Fed came in and announced its injections of loan facilities. And I think the small negativity was just because the peak that we've hit still looks like it might be the peak, but we have not seen a consistent reduction in new cases. The last 2 days now, we've woken up and realized we're not going down like we thought we would started to do. So there is a risk that we stop all of the social distancing too early and we really don't get this under control. And the data at the moment sort of highlights that risk.
All right, let's shift gears a bit. Let's talk about ETFs. And there's that myth out there that ETFs will kill the market. I think, if we take a look at what's happening right now in this environment of COVID-19, that myth may have been dispelled.
Yeah, I mean, a lot of people in the past have said that ETFs are a dangerous tool in the financial markets when we have a sell-off because they're so easy to trade and they trade whole portfolios at once that, when we get a big sell-off and we get a lot of people wanting liquidity, the ETFs will force all of the underlying assets to be oversold and mispriced. And it's not actually what has happened. I mean, you'd have to say we have had a good test of whether ETFs will do that. And the data that's showing in this chart is looking at year-to-date flows and US equities net to buy. The sector funds are arguably a little bit to sell, but that's pretty much aligned with the performance of the different sectors. So it's likely hedge funds that are pretty sophisticated, repositioning for specific sector trades. And we kind of get that feel from the fact that sector funds have very high turnover compared to other ETF asset classes. Even the bond space has had a little bit of selling in high yield, but really not that significant in terms of the underlying liquidity, even of the relatively liquid high yield bond space.
Yeah, and let's take a look at our next chart there because mutual funds and what's happening with bonds tells a little bit of a different story.
Yeah, so much for the ETFs being the tool that would be used to do mass selling. This is mutual fund flows, and it does show that investors, retail investors, have sold bonds, but they've done it through their mutual fund. And so the scale of this chart is much bigger in terms of the net selling that went through high yield and investment grade. It's over $100 billion worth of investment grade and 20 odd billion dollars worth of selling in the high yield space. So you can see from the mutual fund flows that there has been selling that's supported by what's happened to the prices. But net, that market has held up pretty well. The ETFs arguably have provided a lot more liquidity to investors than the underlying markets here.
All right, Phil, thank you so much for everything this week. Enjoy the long holiday weekend.
I'll see you next week.
All right, and thank you for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.